when you have a scientific calculator, you have the price for the annuity, right? For 10-year annuity, and you have the par value divided by 1 plus r to the power 10, and do the same for all the bonds. So you compute it 4 times. So here, right, this you just to get the interest rate sensitivity for any two discrete, right, for the discrete bonds, right, for discrete time value, discrete interest rate difference, you just compute 4 times, right, 4 times here when you compare bond 1 to bond 2, right? So that's easier. So how would you see that if we plot it on a graph, right? So here what we have is just a one data point, right? When we have a discrete case, right? From 5 to 6, right? From 5 to 6. That's when we have a discrete case. What if we have a continuous cases on each point on the horizontal line, right? The yield to maturity. Then if we plot it, it will be look like this, right? The dark blue one represents a 30-year maturity, right? The light green one represents 10-year maturity. So we see that the slope, which one has a larger slope in terms of absolute value? Which one is steeper? Which one is steeper? The blue one, right? The blue one, the 30-year bond is steeper. Okay, and it's actually right twice as sensitive to a change in the yield than is a 10-year bond. This is what we see in this graph. Okay, so you see that the slope is in terms of absolute value, it's about 2 times, right? 2 times the slope of this 10-year bond. Okay. So that's the idea. Any questions so far for the interest rate sensitivity of bonds? The first part, when we have that evaluate the interest rate sensitivity regarding maturity. All right. Okay, so next, what we are going to see is coupons and interest rate sensitivity. So let's consider 2 bonds, each pays semi-annual coupons and 5 years left until maturity. And one has coupon rate of 5%, and the other has a coupon rate of 10%, but both currently have a yield to maturity of 8%. And how much will the price of each bond change if its yield to maturity decreases from 8 to 7%? Okay, so we know that the general direction, right? If the yield to maturity decreases, then the price would increase, right? Then the price would increase. All right. So what do we see here? When we look at, right, when we look at the prices, right, with 8% yield to maturity, then you have 4% interest rate, right, 4% interest rate. Why would it have that? Because we are having semi-annual coupons, right? We are having semi-annual coupons, and it has 5 years left. That means you have 10 payments. Okay, you have 10 payments. And if the coupon rate is 5%, then each year you get $5, right? You get $5. But here, what you have is semi-annual coupon. So you get 2.5. Okay, you get 2.5, and the face value is 100. Okay. For the prices, when the price is 7% yield to maturity, you do the same. Okay. The discount rate is actually 3.5%, right? Because you have a your period interest rate is 3.5%. It's half of 7%. That's your period interest rate. Okay, and here you have 10 and negative 2.5, negative 1. Okay, so that's the idea. And in the end, right, your changes in yield to maturity is 4.38. Okay, 4.38. And when your yield to maturity decreases, right, you actually increase your bond price. Your bond price increases by this. So here we just look at the absolute value. What about 10% coupon bond? Prices with 8% coupon or 7% coupon? You do the same. For it's just that your coupon payment will change. Okay, it will become instead of 2.5, you have 5 for each period. So here your bond prices will increase by 4.04%. Okay, in this case. So which one is more interest rate sensitive? The one with lower coupon, right? The one with lower coupon is more sensitive. Okay, so that's the idea. Okay, but what do you see? What do you see here from my illustration, from the numerical example? The 5%, when we compare the interest rate sensitivity, right, between the 5% coupon and the 10% coupon, and the 10-year bond and 30-year bond, what can you conclude? Which one is more significant? Which one is more significant when we have a interest rate sensitivity? Which dimension? The coupon or maturity? So what do you see here? The maturities actually will make a larger difference, right? Will make a larger difference than the coupon payments in terms of its interest rate risk. Okay, so that's what we have so far. All right, so let us take a short break, and then we will come back after 10 minutes. Coupon is less sensitive than maturity, right? Than the maturity. So if you see a large difference in the bond coupons, they may not vary a lot in terms of interest rate sensitivity, and that's basically due to what reason? For what reason we have this relation? For what reason? We will have this relation. That's because what? That is because most of the bonds, right? Most of the bonds, we would actually most of the bonds, you receive the last payment, right, at the end of the maturity, right? You receive the last payment, so that's why the coupons matter less. Okay. Still, the direction is the same. So the bond with the smaller coupon payments is more sensitive to changes in interest rates, and because it's coupons, are smaller relative to its par value. A larger fraction of its cash flows are received later. And as we learned, right, in this example, okay, later cash flows are affected more greatly by changes in interest rates. So compared to the 10% coupon bond, the effect of the interest change is greater for the cash flows of the 5% bond. Okay, so that's pretty much about the basics of bonds. Okay, so the rest of lecture, we're going to look at some features of bonds. We're going to look at like a callable bonds, floating rate bond, zero coupon bond, which we have already seen, right, so far, and the strips. So it's called separate trading of registered interest and the principal securities. And it's very interesting for strips because we will see why it's interesting and how we may use strips to price bonds, okay, to price bonds. So what do we mean by a call provision? Or more generally, callable bond. So what do we mean by that? So if we allow issuer to refund a bond issue if the rates decline, okay, so that's the meaning of call provision. It will help the issuer, but it hurts the investor. Okay. And what's more interesting, I would say like more than half of the bonds have call provisions. Okay. So the call provisions actually gives the borrower more flexibility, right? So that they can retire the existing bond when the interest rate is lower. Okay. So the borrowers, issuers, they are willing to pay more, and lenders, investors, they require more for callable bonds. Right? Why do we have that? Because for callable bonds, again, right, it allows the issuer to refund the bond. That means to repurchase a bond issue if the rate declines. So that goes against the investor's interest, and it favors the borrowers, right? So that's why the investors would ask for a higher premium in the beginning. So this callable bonds will have a higher price in the beginning. Oh, we'll have a lower price. We'll have a lower price in the beginning and a higher interest rate. Most bonds have a deferred call, so to protect the interest of investors and a declining call premium. So what do we mean by deferred call? A provision that prohibits a company from calling the bond before a certain date. So before a certain date, you cannot repurchase a bond, right? And when the call premium will be higher, when you call back the bond earlier, right? If you call back the bond later, then the call premium would decrease. That's what we mean by declining call premium. Any questions regarding callable bonds? Wait a second. Okay. So let me say this. Okay. So when we have 10-year, right? Say 10-year, 10% semi-annual coupon bond selling for $1,135.9. It can be called in 4 years for $50. So what's its yield to call? Okay, so the question itself is not very hard. Okay, so the yield to maturity, if you compute it, it can be determined to be 8%. Okay, so how do we do that? That is rate. When we have the rate function, no, that's the semi-annual coupon. So the interest, the number of payments is 20. Payment is 50, right? Present value. Okay. Future value is right. Okay, so that's say yield to maturity, right? Yield to maturity, which is 4% times 2, right? Because this is a interest rate for 6 months. So that's why we would have 8% as our yield to maturity. Okay, how do we compute yield to call? To have yield to call, right? We just need to change some of the parameters here, right? We will still use this formula, but we will change the parameters. So what kind of parameters would we change if we want to compute the yield to call? What we will change? We would change what? The future value, right? With the future value when the bond is called. When the bond is called, how much the borrower would pay you? 1,000 or 1,050? It's going to be 1,050, right? So your future value is 1,050. And it's going to be called in 4 years, right? So what does that mean? The number of payments is 8, right? The maturity is 4 years. Number of payments is 8. So here, right, your number of payments is 8. Your each period you get 50, right? You get 50, and you have the price is still 1,135, and the future value, right, is 1,050. Okay, so in the end, right, the yield to call, well, that's for half year, right? It's 3%, 3.57%, and right, that's for half year, semi-annual yield to call. That's a semi-annual yield to call. Okay, so that's how we do it. So for floating rate bonds, okay, what do we see so far? Is say interest it's coupon rate. Actually, it's fixed, right? You have a fixed coupon, but sometimes we will also have a floating coupon. Why would we have floating coupon? If there is like a very high inflation, right? Then say now if we have a very high inflation, and what will you conclude? Your real rate of investment, right? Real return. Your real return of investment would be what? Would it be your 1 plus your nominal, right? And 1 plus inflation, right? So your the real return of investment is your nominal rate, right, divided by your inflation. So what does that mean? That means when your inflation is very high, okay, it surpasses the nominal rate, what would happen to your real rate of investment? Let's say 1 plus. This guy will be smaller than 1, right? Will be smaller than 1 when inflation is very high. So in the end, you get a negative real return, right? You get a negative real return. Actually, right, for U.S. right government bonds, U.S. Treasury, some of the U.S. Treasury actually it is negative interest rates. Okay, real interest rates is negative because the nominal rate is around like 2 to 3%, and the current inflation in the U.S. is 7%. So that's why you have a negative real return. And do investors like that? If you have negative real return, that means you are paying your debt holder, your borrowers, right? You're paying your borrowers. So that's not attractive for investors. So that's why sometimes we would have floating rate bonds. Okay, inflation-linked treasuries. That's one example. Another example would be adjustable rate mortgages, floating rate mortgages. In China, we use this, right? LPR, floating rate. Okay, so that's adjustable rate. So the coupons may have a color, right? The rate cannot above a specified ceiling or floor. So the rate cannot be too high. Otherwise, the borrower cannot afford it, or it cannot be too low, right? So that's to protect the borrowers and the lenders. Okay. Next, so for zero coupon bonds, we already saw some examples of zero coupon bonds, and we may use yield to maturity rate of zero coupon bonds to depict the yield curve. Okay, so what's special for zero coupon bonds, right? It makes no periodic interest payments. The coupon rate is 0, right? That means all its return comes from the price changes, right? So you know that for zero coupon bonds, right? It's a discount. It's so that discount in the beginning, and you will go back to very close to. Actually, I don't think I'm drawing this correctly. It should be this way. Okay, it should be a convex way. Okay, so it will go back to its par value, right, in the end. So the entire yield to maturity comes from the difference between the purchase price and the par value. You cannot sell for more than the par value. So it's also known as pure discount bond. And although there is no interest, your compensation comes from the difference between the initial price and the face value. Okay, so that's the idea. So for zero coupon bond that matures in years, the yield to maturity is satisfies this, right? That's the future value divided by yield to maturity to the power n, right? So this is straightforward, right? The discounted cash flow approach. This is what it gives you, and then you can actually solve the bond yield. That's the future value. That's a par value divided by the price, the current price, to the power 1 over n minus 1. Okay. So if you have like 5 years, then that's 1 over 5, right? Minus 1. Okay. So what's a yield to maturity of a 1 year zero coupon bond with a face value of 100, trading at the price of 96.62. Okay, so that's this one. right? So let's double check that. Right, that's 3.5%. Okay, so in the end, the yield to maturity is this one. Okay, is the future value divided by the price. Okay, minus 1. Okay, so what we would like to do is to use the information right here. We want to get the value for strips. Okay, to get the price value using strips. So one way you may tell, right? One way you may tell from the from the relation here, right, is there is actually if you have a zero, right, if you have zero bonds, then there is a one-to-one mapping between the price and the yield to maturity, right? Do you agree with that? If this is a year zero bond, right, and you know the maturity, then there's a mapping between the yield to maturity and the price. Okay, and the price. So if I know this is 62 as 96.62, okay, I know that it's actually what is actually 100 divided by 1 plus R1, right? Do you agree with that? That's straightforward. So the question is, how we may use this information to to simplify our bond pricing process, Okay, so let me give you an example, right? Say if I have a R2, right? If like say I have a R2 that's 100 divided by 1 plus R2 in the second year. That's 19.4. So you can get R2, right? You may get R2 using this formula. But what does that tell you? That tells you that the prices, that this 19.4 is also the price, right? The price of the 2-year bond, which is 100 divided by 1 plus 2-year interest rate to the power 2, right? So here you can actually map the interest rate with the corresponding price of the zero coupon bond. So here, right, we always talk about those in terms of 100%, right? That's because when bond prices are quoted on the exchange, they are quoted based on the percentage of face value. Okay, say we have it's like say it's quoted, if the bond is quoted as 103.5, that means the bond price is $1,035. Okay, so here, right, again, right, so if the bond is quoted at 96, maybe its value is 960. So it depends on your assumption of face value. If your face value is 1,000, then that's 96% times 1,000. Okay, but here, right here in this particular example, your face value is 100. Okay, all right. So how is that related to strips? We will see that in a minute. Okay, we will see that in a minute. But let me tell you what a strip is. A strip is the default free zero coupon bond. That's treasury. It's treasury that matures on date and provides a risk-free return over the same period. So what does that tell you? If there is no arbitrage, then the risk-free interest rate equals the yield to maturity on such bond, right? So if there is no arbitrage. So we can actually find the risk-free rates with T-bills and strips, and the price is quoted as percentage of value. Okay. So let's look at an example. We have a 10-year bond. Let's say we have a 10-year bond with 40,000 face value and a 5% annual coupon. It can be stripped. So what do we mean by strip? Right, that's strips. Right, you may think it's in this way, right? This is the principal, right? And this is the strips, right? The coupon. But each coupon is also a zero bond. It's also a zero bond. So that's called a strips. Okay, assuming it originally pays coupons semi-annually. So you have 20 payments, right? Each payment gives you 1,000, right? Each payment gives you 1,000. And that's 10 bond. So 21 zero coupon bonds can be created, right? So which means we have 20 semi-annual coupon bond payments. It's a stripped coupon, right? So you may think this as a stripped coupon, has a 1,000 face value, which is the amount of each coupon. And the bond created from the principal payment, that's a 40,000, right? 40,000, 1,000. At maturity. All 21 securities are distinct and trade in the market. Okay. So here is how we do it, right? The stripped principle, right? So how is the ask yield calculated? Here is ask bid price, ask price. When you buy the bond, you buy it at the ask price. When you sell the bond, you sell it at the bid price. Okay, so there is the bid ask spread, right? The ask price is usually slightly higher than the bid price, so that the dealer can make some money. So the ask yield for in this example, okay, for this bond is how much? It's in September 13, 2013, and we would like to know the yield for the stripped, right? Maturing on February 15, 2015. So there are 520 days between these 2 days, right? And so what's your yield? You compute it, right, using this formula. This is your, say, your annual interest rate, right? Your this should be your annual interest rate, and then you times it's this is the annual, so you divide it by 365, then you times the actual days, right? That's the idea. And you use ask a price to get it here. So you get the price. You get the interest rate. So again, here we have a one-to-one mapping between the quotes, the quoted price of the bond, and the interest rate. So what does that mean? Whenever you see this price, you know that it means that your yield is this amount, right? Their yield is this amount. That's similar to what we talk about here. when we talk about here, right? Say when you see this 96, you know that this is this guy. When you see 94, you know that this is this guy, right? So what can you do? What can you do? How you may use that information to simplify our calculation. So when you see the strip's price, you know what? Here, in this example, in this example, what do you know? You know that the price, right, for 5-year annual pay coupon bond with a coupon rate of 10% and a face value of $1. So in a traditional way, we would use, right, 100 divided by 1 plus R plus 100 R1 R2 square plus 100 divided by 1 plus. Okay. Right? We would do this, right? This is what we would how we would compute the bond prices. However, now do we really need to compute R1, R2, R3, R4, and R5? We don't have to. We don't have to. Why? Because we know the strip's price. We already know strip's price. That tells us what? That tells us 1 plus R to the power 1, right? 100 divided by this, because it's quoted in percentage, is 98. Do you see that? We already know that. 100 plus this guy, it is how much? It's 95. This is 90, 92, 89. And you know that in the 5th year, this is what you know. Is 85 in the end, right? That's 85. So it's 11, right? So that's that should be 11 times 85, or you can use this one, right? 85% times 1100. Okay, so this is what you know, right? That's for $1, right? That means for $1 in year one, it's 98 cents. The present value is 98 cents. For $1 in year 5, its present value is 85 cents. Okay, so you use the formula. You just use this to get the price of the bond. All right. Any questions? I think this example is particularly important, right? It's particularly important. And if you can understand this, then you should have no problem in bond pricing, because it tells you, right, how you use the information of another bond price to get the interest rate, to get a discount rate, and then you use the discount rate to get the bond price, to price other bonds. So I think this is very important, and I would encourage you to try to master this. Okay. So we also have some other types of features of bonds. We have convertibles. It may be exchanged for common stocks of a firm at the holder's option. I would say, so in China, this convertible is extremely popular. It's extremely popular. 可转债, the mutual fund bond mutual fund. One of the bond mutual fund is the convertibles, and it's super. It is super popular in China. It gives you very good returns. And sometimes, since we have a callable bonds, we also have a puttable bond. It allows the holder to sell the bond back to the company prior to maturity. Sometimes we have income bonds. It pays interest only when the interest is earned by the firm. And the index bond. So the index interest rate is paid based upon the rate of inflation. Okay, so I would believe that, right? The financial market is very creative. Okay, so people would design different financial products to accommodate the needs of investors, right? So that's why you think you have callable bonds and you have puttable bonds, you have convertibles. That's especially useful when the stock market is in boom. Um, so that's when we have convertibles. Okay, so that's pretty much about bond pricing.